We're going to call the investment committee to order. And Lamont King, Mr. King, would you call the roll for us, please?
Yes, sir. Thank you.
Thank you.
For State Treasurer, Ms. Milleron, Ms. Hendricks, Ms. Dillon, Mr. Rosensteel. For the State Superintendent of Public Instruction, Mr. Zeiger. And for the State Controller, Mr. McGuire. Mr. Keeley, you have a quorum?
Thank you, Mr. King. Jack, do you want to announce some results from yesterday's election?
Yeah, I want to just close the conversation from yesterday since if you didn't stay up to the late hours to see all the numbers and see how they finished up this morning. So yesterday we briefed you on the situations in San Diego and San Jose on Proposition B and Measure B. The final results were significantly different than the polling. Clearly the polling numbers were quite off in measuring public sentiment. In San Jose, the measure passed with 100% reporting at 69.6% in favor. And in San Diego, the measure passed with 66.3%. So essentially all those undecided votes, it would appear, moved into a decided category and voted for both measures. And remember, again, in the case of San Diego, this means a 6-year cap on pensionable compensation and a 401k plan for new hires non-safety. In the case of San Diego, for new hires, it'll be some type of hybrid plan to be defined, and then for current employees, there'll be this severe financial inducement to choose a lesser defined benefit plan. I can assure you, and I say this factually, that lawyers are at the courthouse right now in San Jose, and we've gotten some communication on that. So there's no doubt in the San Jose situation, if you remember the legal weaknesses I went over with you yesterday around that and how those employees are essentially being, I would use the word coerced to make a decision. That's going to be a real interesting case to discuss the rights of those workers. The headlines in the LA Times today for their story on, we've got clips from everywhere around the country, of course, on these two votes. The headlines on the story in LA Times is unions lament local pension votes, focus turns to Sacramento. So as we expected, kind of talked about yesterday, this will form the tension around trying to see whether a deal can be made in Sacramento on the more global scale. So things are obviously starting to move in the political side. I had mentioned to you, if you missed in the national clips also, there was another state government that actually reached closure on reform, and it's a significant one, so I want to make sure you did. We kind of watched lots of chatter always going on, and sometimes you get lost in, is it really moving forward or not, and all that kind of stuff. Yesterday I mentioned that in Pennsylvania they had just introduced legislation to essentially merge all the state pension plans together and propose a 401k for new hires. But in the state of Louisiana, they did reach closure with the governor's legislation. I want to make sure you knew that. So in his case, the governor has proposed, it's funny how the word they used, they said a 401k type pension plan for new hires. Actually, it's not a 401k, it's a cash balance plan, which is actually a defined benefit plan. That's how difficult the media has interpreting some of these pension reform changes. But nevertheless, the legislature did adopt that for new hires, so they'll be going through a rather strong shift in the Louisiana workers as well. A lot of you know, I think, trustees from those plans and things from the Louisiana system. So we'll have to see. I have a feeling this is going to raise the temperature on the discussion at the Capitol, and I still think that we may be back to you soon with some more transparent discussion of where the conversation is around pension reform at the Capitol. Okay.
Thank you, Jack. So with that, we will move on with our business of the day, which is the investment committee work. We will, I'd entertain a motion to approve item number 1, which is the committee agenda and work plan.
Move approval. Second.
Moved and seconded to approve the committee agenda and work plan. All those in favor?
Aye.
Opposed? Okay, that passes. We are now moving directly into closed session. So if anyone is in the room that shouldn't be here at this point, we'd ask that you leave. Reconvene. The investment committee. Lamont, we're okay. Mr. King, we're okay? Thank you. Before we go to item 9, I'm going to turn the microphone over to our chair, Ms. Dana.
Oh, I got a request to speak.
Okay, let me put you in there. Okay, Ms. Dillon.
Thanks.
Sure.
For those of you that have been around us for a while, you know that Harry has a New York connection with Jack and with Ed and Chris, and so it gives me a lot of pleasure to introduce Rick Young from State Street. He and I have a Wairika connection.
Nice.
We both graduated from Wairika High School. Rick went to high school with my brother, and he's here to do a presentation from State Street for us. So, Rick, thank you very much and welcome.
Rick, you guys to come up here to this table here, Aaron? Please. I wanted to introduce Rick Young, who I had no idea was famous. Where is Wairika? Is that in this state?
You guys think of me from Wee, but I actually was born and raised in Wairika.
Okay, a real town.
Yes. Ouch. It has 3 off-ramps too.
There you go. And I shouldn't do this, but I understand the Walmart has 2 dentists. One regular and then a high-speed lane for 15 teeth or less. But I'm bummed. Yeah, where am I working next week? At my day job. So I would like to take this opportunity to introduce Rick Young and Karen Jacobs of State Street Bank. We have had a wonderful relationship. They're a critical vendor for us, and they wanted to make a few comments to you and commemorate. Our servicing on State Street is now done out of Sacramento, just across the river in, is it the Benvenuti building, the library building? What's the name of the building? The U.S. Bank's the library building, but they are here local to us now. So, Rick?
Thanks, Chris. I don't know quite how to follow up on the 2 dentists comment, other than, we do have 3 stoplights, a McDonald's, and a Taco Bell. No, I think, I am relatively new to the relationship coming on with Karen as the business moved to Sacramento, but we wanted to come in to celebrate a 25-year history and to thank the participants and all the people, the board and the individuals that work at CalSTRS for the long-term partnership, and looking forward to a longer partnership servicing your business. Especially, we have a significant presence in Sacramento to help service the business in California, and we take this relationship very, very seriously, and we're very proud of the relationship as well. And so I'll let Karen speak a few words, but overall, thank you.
I just wanted to tell you what a pleasure it is to be so close to you after being so far. But I'm at most of your meetings, and it's been a privilege and a pleasure to be the lead on this relationship for the past 13 years. And I want to ask you and everyone in the audience to join us in a piece of celebratory cake. Thank you.
Let them eat cake. Thank you
Let
so
them
much.
eat cake.
Let them eat
I was
cake.
tempted to put that on the poster, but decided against it.
Well, thank
So
you so
they've
much.
got, oh, sorry, I was going to say, they have 2 cakes in the back, which they're going to cut up, and that's open for the audience. As I had joked with the board, we had told the teachers who are starving today that we had dessert for them. So, Harry?
Very good. So that will be available, and I think we'll continue through. Is that okay with everyone while people are eating their cakes, or do we want to actually take a break to have a piece of cake? I mean, we can continue through.
Let's do
Eat cake and
Yeah,
talk.
we'll continue through, and
We'll try back and grab a piece.
we'll help ourselves to the cake, and the audience will as well. So thank you so much. We look
Thank you,
forward
Rick.
to
It was
the
great
cake. Thanks.
seeing you again.
Thank you.
Great.
Take care.
Okay. So items 9A and 9B are consent. They're approval of the minutes. Any questions or comments on the minutes from 9A and 9B? Seeing none, all those in favor?
Aye.
Opposed? No? Thank you. Item 10, Chris, it's your Chief Investment Officer's report.
Thanks. You grab the, there it is. Cut the cake, please. There he goes. Want to run through a few key points. we've talked a lot about muddling along, and you've seen this slide. I think that phrase has become more consistent. It really, for us, the portfolio is really tilted toward GDP growth, and particularly in the U.S., and it looks like it's going to continue to stay at about 1.9 to 2%. That's at this stage, this late in the recovery, that is the lowest of the last 4 recessions, and I'll bring up a slide that highlights that. I've sent you the information on job creation. We just got this last week, where they focused in on last Friday's report on the May. And it's the fact that the job creation, even as Dr. Rosen had said, has slowed. What's interesting is there are some stats in the economy, like vehicle sales, and I realize that chart's pretty small, but that's a picture of vehicle sales over the last 4 recessions. And the current pace is actually back to what we saw in 1976 and 84. So certain components of the economy are doing very well, but then other components are absolutely stagnant. So particularly in this slide pack that I saw was construction. New home construction, institutional construction are at absolute bottoms compared to the last couple of recessions. And this slide zooms in on really real GDP growth. And you can see the 73, 74, 81, 82, and 90 in the 2001 recession. And we're really at the lowest of all those past recessions, a good 10 quarters past the end of the recession. And we think, based on what Bernanke has said, that that's going to continue on in that path, is very slow, muddled growth. So a couple of things we've already talked about today, but I wanted to highlight. I had sent you an email last week about that, and I wanted to mention it, especially for the teachers in the back of the room. It helps point out the historic extremes that we're at, but we're at a 300-year low for UK bonds. Their 10-year yield is at the lowest level since 1703. I tried to go look at exciting things that occurred in 1703, and I guess if you're Methodist, Martin Luther, one of them was born back then, but and then for the U.S. government, we're actually at a 200-year low. We did touch the low in 1945. We did touch that low last week. And the U.S. government bond yield has dropped as low on the 10-year, has dropped as low as 145. And as you heard, it's back up today. But that really shows you that's a 200-year chart, 210-year chart going back in time with the United States. And so if anything should tell us we're at extreme inflection point, that just screams it. So this is the PCA quarterly risk report that we show you in the CIO report. We also include it in your quarterly reports, and we do publish that. And really what it is showing is the extreme high level of interest rate risk in the portfolio. And I wanted to talk a little bit about what we're doing to protect against that. On the short-term basis, fixed income has the tools already in their policy to be able to hedge extreme movements in interest rates. The other thing we do on a short-term basis is underweight the asset class. We are now about midpoint, but toward the bottom of the range in fixed income. Longer term, we're going to have to come back to you and talk about it as far as how does it fit in the asset allocation? Should we change the benchmark? Or should we make a major policy adjustment about how we view fixed income? I think we have time, even though we're in an extreme inflection point. Ben Bernanke has said, rates are going to be low through 14 possibly, so we have time to deal with this. One thing I want to point out that's a bit odd, while PCA's charts and we talk about this risk, it is not automatically translated into our portfolio. So duration, which is a measure of riskiness of assets. In duration, think of it as the leverage in the fixed income portfolio. If a 1% change in interest rates, a big number duration means you have a big risk at principal. A small duration means you have a low risk of principal. The duration right now of the U.S. T-bond, the 30-year bond, is 21 years. That's the longest it's ever been in history, meaning a lot of volatility of price movement in the 30-year bond. Yet the Barclays aggregate, which we follow, both universal and domestically, is only about 5.1 years. The reason for that oddity is that when the federal government buys bonds, it takes them out of circulation and they drop out of the index. But depending on what the Federal Reserve does, if they unwind Operation Twist, if they put these bonds back into the market, then it will change the duration of that benchmark dramatically. And our fixed income portfolio follows the duration. So right now that risk isn't necessarily translated into our portfolio, but depending on what the Fed does, it may come back into the benchmark, and we'll communicate that with you. So this chart on Europe, I've shown that to you before. I've added the directional change of interest rates so you at least see where they're going. Greece has been a bit higher. France and Germany have really stayed in a range. I added Denmark up there because it really has proven to be a flight to quality. People leaving the bonds of Southern Europe and wanting to head toward the Northern European area. And then a word I heard yesterday on the radio for the first time called Spanic. I'm hoping we don't hear that a lot, but you may, which is the idea of a Spanish bank panic. As much as we talk about the sovereign debt of Europe, the European problem is really a banking problem, first and foremost. The banking system in Europe is almost twice the size of the banking system in the U.S., and it's the fact that these banks own the sovereign debt of their country. So if Spanish debts keep rising, the value of those bonds, remember, bonds trade on a teeter-totter. So when interest rates go up, the price goes down. If interest rates go down, the bond price goes up. So they own, the Spanish banks own a lot of Spanish bonds. As those yields rise, the bonds drop in value and the bank's balance sheet gets worth less. And that's why there's concern about the health of the banking system all across Europe. But it is still going to be all about Europe. Here are two yields I wanted to focus in on, and I sent this to you in an email, but again, for the audience's sake, Spain, the yield in Spanish 10-year bonds has gone up almost 1.5 points just in this calendar year, while the yield in Denmark, their 10-year note, has gone down a full percent. And as you can see, it's really been just in the last springtime here, the last few months. But the yield on a 10-year Denmark note is now below the yield of a U.S. 10-year note. It is below 1%. And it really is showing that flight to quality out of Southern Europe into Northern Europe, and very extreme levels. I say this to you, and I guess I don't need validation, but I found this just last week, a title from Barton Biggs, who has been one of our business partners, very well known on Wall Street. But the title of his paper was that the business is getting more complicated. And I felt there's validation because Barton's been at this for probably over 50 years, a bit longer than I have, thank goodness. But it reaffirms that this is a more complex world than we've seen before. And I put this up there on California time frame. Obviously, the globe doesn't circle around California. But late in the afternoon when Japan opens, the things we're worrying about there is the continued slow growth of Japan. They are still recovering from the effects of the tsunami and now the radiation. The worry about the soft landing in China, every time China has a statistic, you're going to see the markets then focus on that. And of course, we have North Korea as the big unknown. As we go to bed at night, you have to worry about Iran and Syria, but really, it really comes down, as you've heard, to the ECB and what does Draghi saying, what's going on with Merkel, what are the elections in France, what are the elections in Greece. But of all of that, what we care about is what happens at 6:30 in the morning here, which is what are our economic statistics and what kind of growth is going on in the U.S. So it just graphically helps reinforce how complex the world is and the number of issues we're trying to balance as we manage the portfolio. So we're 11/12ths of the way through the fiscal year. I wanted to give you a quick snapshot of where we are. May was such a bad month, we flipped from a slight positive return to a negative return. U.S. equity is now a slight negative return the fiscal year to date. Ex-tobacco still is making a big difference. So people that invest in a pure index are going to have a flat return on the year, where our benchmark is going to be negative, and that's pretty material. You'll see that in the peer group rankings. Non-U.S. equity is definitely the big loser because of the drop in Europe. Fixed income is the best performing asset class. That's great for fixed income, but that also tells you that there's a problem in the world where loaning money to people is much safer than owning things and people are very cautious and very worried. But that also reflects the extreme low of interest rates, how low they're going and how much farther they can low. So without private equity and real estate, those are always 1 quarter lag. So those are December prices in there, not brought up to March 31. Right now, we sit at about a negative 1.5% on the fiscal year to date. And I'll let you know as soon as we get to June 30. We won't know the pricing on real estate and private equity until about July 10 or so. It'll take a while to get that pricing. Here's the asset allocation. We're slightly below target in equity and fixed income. We're above the range, or above target, pardon me, in the longer term assets simply because May was so bad and the plan dropped in value. Real estate and private equity do not change much in value, so we really can't move those dots around. They just are going to land wherever they are as the denominator changes, not the numerator. And really, the only thing we can manage at the staff level is our weighting to fixed income and global equity, deciding whether to be overweight or underweight. And to Paul's question earlier about liquidity, those are the only 2 places we can sell from. We can't sell real estate and private equity very quickly. We have buildings for sale. We are looking at selling some of the private equity, but it takes months and months to do that. And so when we need liquidity, it really has to come out of the public market asset classes. There's the asset allocation as of what it will probably look like at May 31. Total assets back in May 31 were $147 billion. So I know many of the retiree groups and the teacher groups like to write that number in their newsletter after this meeting. And there you can see the asset allocation. You're finally starting to see some exposure to the inflation sensitive and the overlay portfolio. So I keep pointing out to people those will be new slices in that pie chart they'll start to see grow. So you saw the 1-year numbers, but what you really will care about is your 3-year numbers, because when we get to June 30, that's really going to reflect what the actuary is going to report. And the 3-year numbers are going to be very, very positive, which is pretty exciting. So on a 3-year basis, this is through May 31, so we still have 1 more month. This is 35 months of data. The total fund was up about 11.1%. That will trail the benchmark. The policy benchmark will be up about 12, so we're going to underperform by about 80 to 100 basis points, and I'll explain why. Global equity is going to be a double-digit return. Fixed income, a very strong return because of the this year. But even private equity is going to reflect that bounce from 09, and then real estate is even finally showing a positive return to the fund. The underperformance relative to the benchmark is all going to be explained from 2009 from the private equity benchmark. Remember, private equity isn't benchmarked against private equity investments, it's benchmarked against the public stock market. And in 2009, the public stock market rebounded sharply from the lows of March of 09 through March of 010. So over this three-year period, the private equity benchmark is going to say that the return was 26.6%. But again, that's not what private equity investments were able to do. It's just because we use a proxy, a public market benchmark to reference that. And so the difference between our 14.4 and the benchmark at 26 is going to be able to explain all of the negative performance relative to our policy. And that's a case where it's such an aberration in performance. And even though a 3-year period, we know we use the wrong benchmark in private equity, but that's the best one we have. Normally in a 3-year period, we'd expect it to smooth out, but this is such an unusual 3-year period from bouncing off the lows of 09 and carrying forward. I want to explain it now. We'll probably bring it up again and again because I'm sure when Alan shows you that data in September, that will be the immediate reaction is, why did the staff underperform the policy benchmark so badly? And 95% of your answer is going to be right there. So what's going to happen between now and June 30 that we have to worry about? As I constantly say to Jack, you know, it's 1 month that makes a big difference, so we're not at the finish line. Next week, you're going to have the 30-year and the 10-year note auctions. They're going to reopen those bonds and auction more off. So that's our government raising debt. there's been buyers for it, and lots of times excess buyers, but we always get worried about how many excess buyers. The big one that Wall Street's going to focus in on, obviously, on the weekend of the 17th is going to be those Greek elections. Is the left party, the extremists who want to separate from the euro, will they win? Or will more conservative views of staying in the euro win? And I can tell you that probably everybody in Germany is going to be paying attention, because if Greece stays in the euro, a lot of the cost to keeping them in the euro is going to fall on Germans. And I'm told that German citizens still in their pay stub, there is a tax deduction for German unification, which I'm pretty sure East and West Germany merged a while ago now, but they're still getting taxed for it. They often say they do not want to see a line that says euro unification, that they have to pay a tax on that. So that's why Germany is a lot of focus on those elections. The big thing for us really, though, is going to be the FMOC meeting. At 11 a.m. on the 20th is when they'll announce their views. Normally, we'd expect them not to say much and to continue to say that the economy is growing, but it's weak. And we've heard that time and time again. We know that Bernanke said that's going to be true for the next, considerable, at least 18 months. But Wall Street is starting to hope and think about QE3. And I always say Wall Street is like a little kid on Christmas. If it starts hoping it's going to get a new bike, in its mind, it wants a brand new shiny bike. And if you roll out its big sister's bike repainted, it's a new bike, but it's disappointed. So Wall Street gets a lot of expectations. That makes me worried. Later in June, you're going to have the 2, 5, and 7-year auction, and then at the end of June, you have the final revision to first quarter GDP. I wouldn't expect any giant change in that number since it's the third revision on that number, but that last week of June, the markets could shift as well. So we're near the finish line, but we're not there yet. With that, I'm open to any questions you might have.
Thank you, Mr. Hellman. Any questions?
The sugar effect of the cake?
Mr. Rosenstiel.
Chris, the 3-year return, excuse this, might be a really stupid question, but the 3-year return of 11%, is that 11.1% per year over the 3 years?
Yes, these are annualized returns over the 3-year period, over the 35-month period. So relative to your 7.5%, the way it works, which is interesting, is I'll be able to tell you what your 3-year return is by about, say, July 15th. You'll get a full report on it from Alan at the September Investment Committee meeting. But it won't be until May or your April meeting in 2013 that the actuaries will then come forward. Milliman will then come in and report to you, here's what that return, here's how it affected your funding status. And the fact that it's well above the 7.5%, that means the funding status will at least, as we've said, the direction of change will go from a decline to at least a rebound. I couldn't begin to tell you how much it will rebound, but it will improve it just ever so slightly.
Ms. Hendrick?
Chris, can you talk a little bit more about this quantitative easing or the QE3? Because I've heard this in several places where people are talking about this, and I wonder if you could just talk a little bit about that and implications for us.
As I often joke, Queen Elizabeth III. QE3, basically the Federal Reserve's main tool is to change the discount window or the short-term borrowing rate that exists in the U.S. That's at 0. That's at 0.25%. They have no tools. So all that's left to them is to try and come in and buy bonds in the market and try and twist or change the perception in the market. They also have the tool of language of trying to talk to the market and jawbone the market a bit about things. What they're constantly talking about doing is a twist strategy where they issue bonds in one part of the market and buy bonds in the other part of the market to try and manipulate interest rates. The key to a QE, any of those, is it's their way of stimulating the economy. The Fed, their job is to either stimulate the economy or contract the economy because they have a dual mandate. They have to worry about full employment or achieving that, and they worry about inflation. Those are actually normally opposing problems, and so you can never solve them perfectly. But people feel very strongly that Bernanke and the Fed Open Market Committee are mostly focused always on inflation. And they have said very clearly in their testimony that it's now up to Congress to do something about employment. They can't stimulate the economy any more than it is. It won't create jobs. So they're going to try and do things into the bond market that, at least, as I've said to you in emails, it's like giving a 5-year-old a Coca-Cola. You know, a 2-year-old, if you give them Coca-Cola, they bundle of energy and then they crash. A 5-year-old is probably a better description of our market. It has energy. It doesn't crash. It has energy, but then it just wears off. And so QE1 is what definitely saved us from probably a depression. During the Great Recession in March of '09, the market rallied and the world bounced. QE2 came in and helped the market a little bit more. QE3, which they did in February, right?
I was going to say it hasn't happened
QE2,
yet, right?
well, yeah, Operation Twist, which was QE2.5, so 2A and 2B. There's a big debate about whether that really helped the economy or not. And so it's kind of like, you know, they're trying to implement tools, but maybe they're out of influence to some extent. That doesn't stop the market from still hoping for that stimulation, because people look at the weekly jobless claims numbers that I've been sending you, the fact that those have flattened, they're not improving. It makes the markets nervous, and they want corporate earnings to continue to grow, so they want that level of stimulation. So that's why I said I normally would expect the Fed to come out and just say their standard line and let's just keep moving on, but now the market's starting to get anxious about wanting some stimulation, and that's a hard place for the market to be, because I don't know if the Fed has much power left.
So just a general question then. So how does the investment staff look at all this information and then move forward in terms of the decisions that we're making to try and increase our returns and mitigate risk? I mean, how do we proceed forward given all this information? How do you guys make your decisions in the next year in terms of where we're going to invest and where we're not?
I'd answer twofold. How we invest in the next year to 3 years, a lot of that longer term direction is set by you in the asset allocation. And we do the asset allocation every 3 years. So you're really charting. I always say to teacher groups, you guys can verify this, I always use the analogy that we're a big cruise ship. CalSTRS is the oil tanker. Sorry, Terry, Pam. But we're a cruise ship, and because it's more fun. You set the target on the horizon. You're the investment committee. You set the target for me on the horizon. Aim for that. My job's to go up into the crow's nest and look around for problems. And we can't spin the ship on a dime. We're just too big. But we make subtle course corrections, because if we tried to spin the ship on a dime, we're going to kick up a lot of transaction costs. And literally, in my analogy, we're going to knock everybody over and ruin it. So longer term, you set the target. Shorter term, the investment staff is really focused probably somewhere between 18 months to 3 months is our time horizon we're looking at. And we're constantly talking about these issues I have on this slide. The Tactical Asset Allocation Group meets monthly, as you know, or ad hoc. Each of the asset class, and if any of the directors want to come up and talk, please do. But I know in Michelle's group or in Tricia's group, global equity or fixed income, they will debate these issues internally about where do they tilt their portfolio within global equity. Where do they want their exposure to be to Europe? What are the managers saying about Asia? Where should they be relative to the U.S.? So they're factoring that in at each decision level down into the portfolio. At the tactical asset allocation level, we have been looking at this map and saying this year, we like the U.S., but we don't like some of the risks because they could be almost catastrophic in Europe. So therefore, we're neutral to slightly underweight on our equity exposure. And now we're going to underweight fixed income because of our fear of that risk of that market. And as we look forward into the next 6 months, I want us to be pretty rich in cash. We're trying to build the cash position up to be 2, almost 3% of the fund. So we're rich in cash going into next year, which is a bit defensive for us. We think the summer has a lot of uncertainty in it. The U.S. market is still strong. I talked to Larry Fink, who runs BlackRock 2 days ago, and he's still very bullish on equities because fixed income is such an extreme risk. So we're going to position the portfolio that way, but we don't feel comfortable being aggressive in this kind of a market. And we want to, Wall Street always climbs a wall of uncertainty. There is always fear in the markets, and there's always something to worry about. But when we've run PCA's risk model, and we had a conference call with them, there certainly is more downside risk in the equity markets than upside opportunity. Literally on a dollar term, when you look at our portfolio, we have too much, it would be too much of a risk for the little bit of gain, and that's why we're going to be defensive going into this. And that picture gets altered every time there's a news story, you know, with the Greek elections, the French elections, even where Merkel and her party lost an important election in a conservative part of Germany. You just have to now factor that in. So it's a moving collage all the time. And that's, you've heard me say, it's science and art. If it was a checklist and you could put it in a computer, you'd run it that way. But it really is more of an art form of evaluating all of these things all the time.
I was going to comment though, is that the better way for me to be thinking of it in terms of, I understand the cruise ship analogy. I know we're long-term investors, but I also know that we're always trying to make tactical shifts, you know, as we kind of look at the 3 to 5 year horizon. So is it better to think of it in terms of where do we tilt, you use the phrase, where do we tilt our portfolio? Is that, I'm trying to think of how to think of the short, sort of the 3.
The short term for us is very small tilts. We do not shift the portfolio dramatically. That's why I literally use that analogy. And I've often said to, there's usually a retiree teacher group that will always say, hey, but cruise ships have side thrusters. They can move sideways now. We don't, it is true, yeah, we don't manage the portfolio that nimbly because of our sheer size. We believe, and Paul and I were talking about this yesterday, do you believe in being tactical and being active, or do you believe in more long-term buy and hold? And our historic philosophy has always been more long-term buy and hold. We've talked to you in the risk modeling about being a bit more tactical, and we're going to come back and talk more about that. Our long-term buy and hold strategy definitely worked to an advantage in the 1980s and the 1990s. It has not helped us as much in the decade of the 2000s, and that naturally warrants us to want to go back and look at that and figure out what we at the staff are doing is typically shifting $500 million to $1 billion, maybe $3 billion. So that's, you know, 1% to 2% of the overall portfolio. I know a prior investment committee chair used to kind of say to us, you know, that's just on the margin. But that's part of our philosophy from you has said, don't swing for the fences. Don't try and dramatically shift the market. And we'll have that discussion on an ongoing basis. As you become a new board, do you want to still have that mandate?
Any other questions? Okay, seeing none. This is an action item. It's informational, yeah. Okay, so thanks, Chris. Item number 11 on the agenda is the committee input for fiscal year 2012-13. I want to remind the committee members this is an opportunity for us to give some feedback and input into the committee work plan for next year. It's not final until we adopt it in July. So Chris, you want to talk a little bit about this item and our role in crafting the work plan?
Yeah, what we'd like from you is you drive this agenda. This is not from Alan or myself and the staff to say this is what you should study. The suggestions, and these are only suggestions on here, are based on what the committee has brought up in the past. The number one thing you need to do next year in your work plan is an asset allocation. It comes up every 3 years. The last one was in 2009, so this one needs to start in 12. as Harry and I have talked about it, it's clear from the questions from the new board members that we really should spend a lot of time in the asset allocation study. Probably, normally we would do it over 3 meetings. We may take all of those 3 meetings and even go into a 4th meeting to really spend a lot of time to make sure you're comfortable with what are the inputs. It's all about that 7.5%. So it's all about what is that target on the horizon, how much risk and how much return. I can't emphasize enough, that is set by you. It's not set by me or Alan or the actuaries. You decide how much risk and return we shoot for in this portfolio. So anything else you want us to study or take the time to do next year in addition to that would probably occur a year from now in the June meeting and the July meeting. So I hate to scale back some of the things you'd want to look at, but what I need to know from you is what else. We definitely will do ESG and environmental. That's a continuing theme for us. We will definitely do diversity and investment management. That's a continuing theme for us. And then managing the portfolio. But what extra stuff, like we talked about Ken Rosen, what extra things would you like for the investment committee next year?
I just want to reiterate what Chris said, that asset allocation conversation is a major part of our work next year. And then in the second half of the year, we actually will be looking at 2 of our consulting contracts as well in that process. So Chris, during the asset allocation conversations, will we engage in some dialogue around the whole historical picture of institutional investors, by and large, being buy and hold, a lot of exposure to growth and equities as a strategy that's worked well, but on a forward-looking basis, whether or not that's going to be the same approach that's taken?
And I'm going to have Alan come up because what we do here is a bit unique. Instead of a traditional asset optimizer, we use PCA and a firm, they work with an actuarial firm to give you more of a holistic asset allocation study. Alan, do you want to describe it a bit?
The study will address risk as you define risk, not the way it's traditionally been defined as standard deviation. So that could be funding levels, pension cost, level of uncertainty, downside risk. These can be quantified, put into context of the relationships in the assets and the liabilities to help you make decisions with decision metrics that have to do with the real world, not the statistical world. But we add on to that a discussion that hasn't happened in the past, and that is, particularly in today's world, do you care more about relative returns, which is what completely drives everything right now relative to the benchmark, or do you care more about absolute returns? And having that discussion, no matter how you end up on that decision, that discussion will be much more important than whether you make a 20% or a 22% investment in fixed income versus another asset class. Because you manage a portfolio very, very differently if you manage it in absolute as opposed to relative performance.
Thank you. Okay, so Chris, how do you want to proceed with the question, the members filling out this document?
Well, I think what we'd like to do, we talked about, there they are, we talked about doing it interactively, but what I think would be best is if you would fill these out. You get 7 points, allocate them as you want, all to one or spread them out. And what we'll do is collect them and bring it to you for the July agenda item, which Harry will present at the retirement board, which would be your final agenda of what do you want to work on.
Perfect.
And I guess the big thing, Harry, I'd like to know if the committee has others they want to add and advocate for so the other board members could vote for it.
Sure. Before we do that, Mr. Rosensteel.
Well, that was exactly my point. I mean, if there's nothing else on this list, these are the only things we're going to be. I mean, my own personal feeling is I just think it's this larger question of asset allocation and risk and how we measure risk and how we do the risk overlays, which I'm not quite sure I understand that we've adopted the 6 risk overlays onto the asset allocation, and is there a next step in that, in integrating the two? Because that seems to me to be the most important issue if we've gone this far in evaluating these 6 risk factors.
Yeah, to address that, so what we've done is you've adopted 6 risk factors, and we need to integrate that into your reporting so you see it. We started to come to you with tools to now manage those risk factors, and we backed off. And what we thought, we want to come back to you. We want to come back in next fiscal year. We were somewhat waiting for the rest of the board to be filled out, and obviously that's, can't wait forever. So our plan was still to come back to you with those, but we balanced your meeting time so that we didn't overweigh that. But I think that would be an important thing to consider doing next year.
Okay. So are there any other items that board members would like to have considered for the work plan to be voted on? Okay, seeing none, then we could all just fill these out, and Sue, can you collect them from us and make sure that Chris gets them? Yeah, thank you.
Can we get copies? Because those of us who just have it on the.
Oh, so
We never.
so who
never
needs
have
a copy?
printed
Yeah, who needs copies of the form to fill out?
Ha-ha, the advantage to having a print book. Sue, mine's ready.
Staff has the paper, we'll take
The
them,
iPad.
hand them in.
There you go, Pam.
Exactly.
I think next time you need to create an app for that, Chris, basically. An app? An app. Dana has her iPad now.
That's right, yes.
We
I'm
need to
trying to
build
get
a text vote or,
We will work on a creative interactive
I was
app.
just kidding, really.
All right, Chris, as we're filling these out, we can move to item number 12, which is the update of investment committee charter to reincorporate corporate governance activities. So we'll fill these out and we'll move right to item 12. Chris?
Item 12 is pretty straightforward. Now that you've taken the governance action on the corporate governance committee, we wanted to reincorporate it into your charter as an investment committee, and we're prepared to approve it or take any changes you may propose.
It's been moved by Mr. Reyes to approve the item. Is there a second?
Second.
Second by Ms. Hendricks. All in favor?
Aye.
Opposed? Okay, that item passes. Thank you. Item 13A and 13B are both consent items. Anyone want to pull either one of those items or have questions for staff? Okay. Okay, seeing none, we will move to,
I have a question.
go ahead.
What do we label a consent information? Why not just information?
Because some of them,
I'm sorry.
You changed it that way, who knows?
Go ahead.
because some of them we actually took action in.
Yeah.
Yeah, but this is either an action or informational item. So why have a consent information?
Meaning, I'll repeat the logic.
Yeah, I mean here.
I think it was that you wanted, there are some items that are informational that are labeled as needing explanation, discussion, so that's purely informational. And then you had consent items that were not actions of the system per se, like an adoption of a rate or adoption of a contract. So they're truly 2 layers back information. That was your thinking at the time.
Just to speed up the
Yeah, it was used to have a more generic consent. We're totally agnostic on this topic, though, if you'd like to.
I don't understand now.
Okay.
We're at your service, these Chris's.
All right.